Hello everyone, today we're diving into something super important, your money. We're talking about Indexed Universal Life Insurance, or IUL. It's a special kind of life insurance that does more than just protect your family. It also helps you build cash value over time. An IUL is permanent life insurance, meaning it lasts your whole life as long as you pay the premiums. The indexed part means your cash value growth is linked to a stock market index, like the S&P 500. When the market does well, your cash value can grow faster. But your money isn't actually invested in the market, so you're protected from losses. IULs give you both a death benefit and a way to save for the future. Unlike traditional life insurance, you can access your cash value later in life. It's about having options, protection for your loved ones, and a chance to grow your savings. We'll break down how it works, the benefits, and what to watch out for. Stick with me. Understanding this could make a big difference for your financial future. Let's get into it. How do IULs stand out? Term life is simple but temporary. Whole life is safe but slow growing. IULs offer permanent coverage, flexibility, and growth tied to a market index without risking market losses. They balance safety and growth, making them unique for those seeking protection and potential. Ready to see how they work? Here's how your IUL grows your money. Your cash value isn't invested in the stock market, but its growth is linked to a market index. Each year, the insurance company checks how the index performed. If the market goes up, you earn interest up to a cap, like 10%. If the market tanks, you don't lose money. There's usually a 0% floor. So you get upside potential without the risk of losing your principal. There's also a participation rate. If it's 80% and the index gains 10%, you get 8%. The trade-off, you miss out on the highest highs, but you're protected from the lows. This creates steady, reliable growth over time. You won't get rich overnight, but you won't lose sleep during market crashes either. That's the balance IULs offer. Let's talk about the pros and cons. Let's break down the pros and cons. Pros: tax-deferred growth. Your cash value grows without yearly taxes. You can access your cash value tax-free through loans or withdrawals, up to what you've paid in. Downside protection: your cash value won't drop if the market crashes. Plus, your family gets a tax-free death benefit. Cons: IULs can be complex and have fees that eat into returns, especially early on. Growth is capped, so you'll miss out on big market years. Returns aren't guaranteed and depend on the market and policy terms. If you're young and comfortable with risk, direct investing might offer better long-term returns. IULs are best for those who want growth with protection. Always read the fine print. So, who should consider an IUL? If you want lifelong coverage and a way to grow savings with downside protection, it could be a fit. It's great if you've maxed out other retirement accounts and want more tax advantage growth. IULs suit people who want market-linked growth but can't afford to lose principal. They work best for long-term planners. Think 10, 15 years or more. Not a quick fix, but a steady strategy for future goals or leaving a legacy. If you're patient and disciplined, an IUL can be a smart part of your financial plan. Remember, it's not a direct market investment, but a unique insurance product. Talk to a financial pro to see if it fits your goals. Let's wrap up. Thank you for joining me today. Until next time.